Okay, for those of you via the blog here, we are in Finance 370. This is a business finance course. It's a core course. We have a blog for those of you who do not know that is coming live in the next month. So we're filming a couple classes here and there. And I don't think you'll be shown, so feel free to talk like normal as we go forward. But what we are doing today is we are basically learning some financial analysis skills. And so I have a packet of information for you. This is Alcatraz Corporation. So we got a balance sheet and an income statement. If you're watching via the blog, I think we're going to put it on the blog post as well. We have an Excel file you can download. What you're going to see here is a balance sheet and an income statement are the first two tabs. And so we have two different years, just a basic balance sheet and income statement. Just as a quick review, you got your current assets and your non-current assets, your long-term assets right there. You got your current liabilities, and here's your long-term debt, and then your equity items right here. So we got year over year for 2 years. And then we have an income statement as well for 3 years. So this is something that you might see in a little bit more complex form whenever you look at a publicly traded company and you're trying to decide, do I want to invest in this company or not? So Apple's a hot stock now. You know, they're $670 per share. They're coming out with iPhone 5. Should you invest in Apple? Well, before you do that, hopefully you download their financials and give it a little review here to see whether the financials, the underlying financials are good more than just the rumors of the iPhone 5 coming out that are driving the stock price. So what we're doing here today is we're learning some skills to look at a balance sheet and income statement to see whether this company is strong, whether the company is not strong. So on the PowerPoint slide, let's just go through a couple things here. This should be available on the web as well. We will just talk. The first thing we're going to do is horizontal analysis. And whenever we do horizontal analysis, we are just looking at change year over year. Okay, so you could do this with a number of things, even outside the financial statements. If you were trying to figure out what your percent raise was or what the percent tuition increase at Biola was year over year, you would be doing horizontal analysis. So all you're doing here is basically taking the current year minus the prior year, and you're dividing by the prior year. Okay, so just a simple example, if you made $1,000 in some summer job last year, and then this year you made $1,200, if we were putting it in the formula right here, we'd have 1,200 as our current year, minus our 1,000 for the prior year, divided by your 1,000. Your beginning, your base is always your denominator right there. And so you would look at this and you would say plus 20%. Okay? So we can do this on several items on the financial statement. So what I'd like us to do here is let's just flip over to our Alcatraz balance sheet. Let's start with this right here. Okay, so 2010 is our base year that we're going to be using as our denominator, and 2011 is the current year. Let's just, we don't necessarily have to go through item by item here, but take a couple minutes here and try to see what sticks out to you. Figure out the horizontal analysis, the change percentage for some key lines here where the significant changes are year over year. I'll give you a couple minutes to do that. You don't need to calculate all 15 or so. Just pick a couple big ones here, and we'll just discuss those and make sure you can do the calculation as a skill set. Get your calculator out here if you don't have one. Al, you're going to use this as we go forward, so you're going to need that all class. Kent, you want to start us out? Anything that stands out to you? Kent?
I was trying to get my calculator out.
Okay. Someone else have something that you want to pick out? Some big change from 2010 to 2011. Carl, what you got?
Total assets.
Okay, so we're looking here at total assets, at this line right here, the difference between the two. How did you come up with your percent change here?
6.37.
Okay, so you got 6.37. So if we were putting this in a formula here, we would say the current year, 3,588, minus 3,373, divided by which? 3,373, the base year. And let's just put that together here on the slide if I did. That sale minus that sale divided by 2010 sale, And we could put it in a percent form, 6.37. There you go. Now, Carl looked at this, and total assets is important, but what you might want to do is, total assets is a subtotal. So all that's doing right there is adding up cash, accounts receivable, inventory, and property, plant, and equipment. We might have 2% here or 1%, not a big change, but there could be what we call elephants passing in the night. You could have one account going way up, one account going way down. So what we really want to do is get a little bit deeper into the actual asset lines. Kent, did you have anything there?
Yeah, I got one. The total current assets.
Okay.
10.28.
Okay, so now you're looking at this line here. Well, I think we're kind of doing the same thing. What is total current assets? Total current assets is the sum of cash, accounts receivable, and inventory. So I'm just going to copy that cell up. And you said 10.28, was that right? Okay, so that is correct. So both of these are going up. So we're increasing the size of our business from 2010 to 2011. But these are still both subtotals. So let's put those here in yellow. What's the biggest driver of these increases? You got 4 accounts to choose from, basically. Anything going on there? Property, plant, and equipment, you want to see what this change is? So let's put that right there. I'm just copying the cell. If I wanted to calculate the cell on our own, basically for this we would have 2880 minus 2731 divided by 2731. And that number right there would be 5.46%. Okay, so you got an increase there in PP&E. Let's just copy that cell up to the other ones. Okay, so you got some bigger changes up there in current assets, though. Okay, so if we did the year-over-year comparison between cash, AR, and inventory, cash is the biggest percent change. Now, that's only, if this is in millions, you got the heading up at the top, so always read your headings to make sure you know what dollar amounts you're talking about. So that's only 14 million that we're increasing, but it's a big percent year-over-year. So that's a big individual change here. So we could do the same thing for our other items down below. Let's just pick our other pieces here and copy these down. Accounts payable, notes payable are long-term debt, common stock, and retained earnings. Now you notice I kind of skipped over our subtotals. The first thing we did was look at the subtotals here, but you really want to look more to the individual line item level here. So are they increasing their debt or decreasing their debt here? What? Yeah, so when you got a negative here, that means it went down by about 14% here. So they decreased their debt pretty substantially. What about their equity? Their retained earnings and their common stock are both going up here. So you see they got a capital structure shift between more debt in 2010 to more equity in 2011 here. Would you say that's a good change or a bad change? Most people would probably say that's a good change. Okay? So you would analyze this and you could say, well, they're paying down their debt. Some of their assets are increasing here. They're increasing the size of their company, but they're increasing it more through equity than debt. And so that's probably a good indicator of what's going on. Any questions on what we're doing right here? Feel free. You're not going to be on camera. Okay, we could do the same thing for the income statement, and we might have a little bit more interesting information on the income statement. So what we need to do, here's our income statement year over year. We're going to do a similar format to what we did on the balance sheet, but we need to do current year minus the prior year divided by the prior year. Well, we need to figure out what our base year is. What is our denominator going to be? And for simplicity, let's just go with 2010 here. You could do it year over year. You could start with 2009 and go to 2010, and then you could do 2010 to 2011. But let's just take 2010 and go to 2011 as a comparison here. So this is our base year. This is our current year. Try to figure out what our component changes are, our horizontal analysis year over year. See what stands out to you. I'll give you a minute or two to do that. As we go through these, just so you know, on page 3 and 4, I kind of got the built horizontal analysis results there. But let's just do it on our own here on page 2. So ignore 2009 for now. We will hide that. What are we seeing year over year on our income statement? Anything big going on? Go ahead.
We have a 25% increase in sales.
25% increase in sales. So right here you did that cell, 2,500 minus that. Let's put them in parentheses here. Divided by the 2,000. and you got 25%. Very good. Most people would say if you're growing by 25%, that's pretty good indicator there, year over year. Okay? Is that the most significant thing going on? Sterling, what you got?
The 30% decrease in net income.
30% decrease in net income. Okay, so if we took that and dropped it down, negative 30% on net income. So someone to look at this as our bottom line or net income indicator, and that's a pretty poor result there. We're losing significant money from what we did before. Kent?
Interest expense is up 150%.
Okay, interest expense is way up. So we could ask the question, if we started here on net income and we dropped down 30%, why are we dropping down 30%? What is changing? Let's copy that up to interest expense there. Okay, big jump here. We have significantly more interest expense than we did before, 150% more than 2010. We would need to look at this and we would say, why is our interest expense going up? Either we took out significantly more debt, maybe our interest rate adjusted and we have less favorable terms from our bank, something along those lines. But this would be a big indicator. If this stayed the same, so you basically lost $180 million in additional interest in 2011, that would actually be more than 280 in 2010. So that was a big reason why we were down in terms of net income. Anything else that sticks out? Okay, so depreciation, if I copy that up there, depreciation is also up quite a bit. Okay, so two major expenses up here are quite a bit, even cost of goods sold as well. So that was up 25%. So if we looked, taxes, we'll put that there as well. So taxes are down, why? Because it's a percent of taxable income here. So we would expect if this goes down, then our taxes go down as well. That makes sense. But the line items that the business could actually impact themselves would really be these four things right here. Let's put those in green here. Okay, so we had a 25% increase in sales is what Jose said first. Well, that's a good thing, but we pretty much lost all the benefit of that from a more than 25% jump in our other expense items right here. So would you say income statement up, down? Yeah, it's a lot weaker than it was in 2010. Okay? All we did here was year over year, just with this simple formula right here. If you can remember this, then you can do that skill for our financials. Okay? Any questions on horizontal analysis there?
Is it always current year minus prior year divided by 5?
Yep. Your base year is right here, and then this is your current. Okay. Okay. Flip back over to the PowerPoint here. Let's talk about vertical analysis. Sometimes you see that called common size financial statements. Okay, so flip back over to our financials on page 1 and 2. This is where we started our balance sheet and our income statement, and I'm going to go ahead and take all this off, and we'll kind of start fresh. Okay, so let's say we have this size of a company here with, if these are in millions, that would be $3.5 billion in assets. And we wanted to look at our structure compared to some other company that wasn't either near as big as $3.5 billion or significantly bigger than $3.5 billion. Similar thing over on the income statement. We have $2.5 billion in sales here. We got $195 million of net income. What if we wanted to compare our business to a smaller business? What if you're comparing Apple to Disney or some other smaller business? Well, the way that you go about this is our common size financial statements, okay? What we're going to do here is we're going to take every line item on our financial statements, whether it's our income statement or our balance sheet, and we're going to express that as a percent of some item on that balance sheet, okay? So whenever we do our income statement, if we're going to do a common size income statement, we're going to express every line item on that income statement as a percent of current year sales. We're going to ask, out of every sales dollar, what was used for depreciation, what was used for interest expense, those type of things. When we're on our balance sheet, we're going to take every item on the balance sheet, we're going to put that in the numerator, and we're going to take total assets as our denominator. Okay? And then this is going to allow us to compare not only year over year, we're not going to only be able to compare 2010 to 2011 to see whether we're getting stronger or weaker, but we're going to be able to compare ourselves to other companies of different sizes. Okay? That's the idea here. So let's flip back over to Alcatraz. Let's start with our balance sheet right here. So we just said a second ago that our denominator is this total assets. So for 2011, we're going to basically take, and we're going to be re-expressing this, and not in numbers of dollars, but we're going to be expressing it as a percent. Okay, so we're going to ask the question, what percent of total assets is cash? What percent of total assets is accounts receivable? And then we're going to be able to compare that to what we did in 2010. Okay? Whenever we go over to the income statement, we're going to be doing a similar thing. Let's bring back up our 2009 year. So we're going to be taking all these numbers right here and we're going to be expressing them as a percent of sales. This is our denominator for each year. Now, let's say we're doing 2010 right here and we want to figure out what our percent is for this line right here. Well, we're going to take 1,200 and we're going to divide by what? This, that, or that? It's that 2,000 right there. It's going to be your current year sales. So we could do our numbers here and our denominator is going to be the 2,500. When we move over here, we're going to be picking those numbers as our denominator. Okay, so I'm going to give you 3 or 4 minutes here. Let's start with our balance sheet. Let's do some common size numbers on our balance sheet. You don't have to do all of them. But just as a check, let's figure out what that guy, accounts receivable, notes payable, and retained earnings is as a percent of our overall business. And let's do it year over year. Okay, so let's figure those 3 out at a minimum, and we'll come back together here in just a minute, and we will look at that. Okay? You understanding the prompt? You understand what I'm doing? What percent of our total assets for this year is accounts receivable? And we're going to compare that to 2010 to see whether accounts receivable is now a bigger part of our business or a smaller part of our business. Okay? We saw before that accounts receivable went up. When we did just a horizontal analysis, well, it went up around 10% or something like that. But how did that compare to the overall size of our business? This is what our common size financials are going to tell us. So take a minute and do some numbers there. Okay, let's go through a couple of these together. Let's start with accounts receivable. Anybody want to start us out? Kim, you want to help me out with accounts receivable? How did you calculate your common size percentage for that guy right there? Okay, so you took this individual line item for account receivable right there, and you divided it by your total assets right there, and you said that accounts receivable for 2011 was 5.24% of total assets. Everybody with me on that? We would do a similar thing for 2010. The whole point is to compare it and see whether it increased or decreased as a percent of the business. So for 2010, we take that number right there and divide by what, Kim? Right, the total assets for 2010. And you see that, let's get a little more data here. So they were pretty similar, but accounts receivable went up. As a part of our overall company pie, accounts receivable is now a little bit bigger pie. A little bit bigger slice. 4.9% compared to 5.24% right there. What about these right here? Bob, you want to take a stab at accounts payable?
Yes, can I use my phone as a calculator?
Sure. Chris, what do you get for accounts payable here?
Accounts payable.
Yeah, this one for 2011. What did you come up with?
Oh, I got a 9.6%.
9.6. Okay, so if we take that and divide by total assets, it's rounded a little bit. So let's see, 9.59, 9.6%. Okay, is that more or less than it was in the prior year? 312 divided by the 3373. And so that one's a little bit larger as well. So these aren't major changes. These are fairly small percentages. But let's go down to retained earnings here. It looks like there's a pretty big jump in retained earnings. So if I took 2041, so that's my retained earnings for 2011, divide by the total assets, 57% compared to, in 2010, 53%. Okay, so that's a fairly big jump. That's about 3 or 4% there that retained earnings is jumping up. Chad?
Is this just called vertical analysis, or are you getting, what's the percentage called that we're actually?
We're getting the component percentage, but it is vertical analysis. So why is it called vertical analysis? When we did horizontal, we were going across, right? So we were comparing the relationship between these two. And we said, well, it went up 10% or something like that. We're doing vertical now because we are only in the current year. So we're looking at the relationship between 2011. And then we're looking at the relationship between 2010. And then we can compare them, but the idea is that we're expressing them vertically in a percent of the whole there.
Is it always going to be divided by total assets?
Yes, on the balance sheet it is. Okay, so if we flipped over to, this is page 5, I believe. Here's our balance sheet common size. And so we've already calculated some of these. Remember, we just did our component percentage for retained earnings there. I'll give you a second to get over to that page. It's page 5, correct? Okay. Okay, and what you could do if you wanted to is you could actually do a little calculation here to figure out the change across year to year. So what's going on here? So I've basically put all the numbers up here on the screen. If you had time, you could have done this yourself. But what would you analyze this vertical analysis change between the years to say that the company's doing well, doing poorly? What do you think? Chris, is it going the right way or going the wrong way? There's not a whole lot here, but the things that are above 1%, what do you see is going on? Why is that? Total assets is right here. So this percentage right here is always going to be 0, right? Because these are always going to be 100%. Okay, so we're going to have to look at the other items. But what other items do you see? Hang on. Okay, someone else jump in here. What'd you have? Okay, so one thing you could look at right here is that long-term debt is down 3%. Okay, so out of $100 of assets, now we have $3 less of debt year over year. So that's fairly substantial there. Where is it moving to? We lost it here, we picked it up where? Retained earnings right there, okay? So we basically shifted some capital structure from debt to equity. And we came up with the same analysis whenever we did horizontal, right? And we said they were moving some, our long-term debt went down as a percent and our retained earnings and equity went up as a percent. We kind of came to the same conclusion. This is a different way to go about doing it, okay? What could we do with this right here, even outside of our Alcatraz company? You could take 2011 and you can compare it to some other company. Okay, so you could do the similar analysis for a different company and compare percentages and see whether, what the inventory percent of Target versus Walmart is and see how they change year over year. Okay, let's go back to our income statement. Let's do this for our income statement. So let's do it for all 3 years here. And this shouldn't be that bad. Remember that our denominator is always our current year sales. Okay. So what we want to do is we want to trade these numbers. We want to trade the dollar numbers for percentages. What's this line going to be when we do vertical analysis or common size financials? This is always going to be 100, right? Because this divided by total sales, it's always going to be 100%. And these are going to be smaller here. So take a minute and figure out your common size income statement. Let's come back together here and let's go through these. Let's start with 2011. Kyle, why don't you help me build some of the 2011 numbers here? So if I was going to take 2011 right here, and I was going to figure out my component percentage for cost of goods sold, what numbers would I do?
Cost of goods sold, which is 1,500.
Okay, 1,500.
Divided by your total sales, which is 25.
Okay, so 1,500 divided by 2,500 is 60%. Okay, simple enough. If I was going over to 2010, how would I change that up?
1,200 over at 2,000.
Okay, I'm just shifting everything to the right. Now 1,200 divided by the current year sales right there. So it turns out it's 60 as well. And for 2009, it would be 1,000 divided by 1,900. Okay, so it's going up right here. Would that be a good change or a bad change? Bad change. Cost of goods sold is an expense, right? So that's increasing. So let's look at net income here. Anybody see that something significant is going on with net income? Okay, so go ahead.
Profit margin
Your profit margin is going way down. Okay, so and that's calculated in the same way. This is going to be your numerator. Your current year sales is going to be your denominator. So 195 million divided by the 2.5 billion, so 7.8. Let's compare that to year over year. I'm just going to copy my formula over. Okay, so big drop. So over here we were making $20 of profit for every dollar of sales. That is going way down 2010, 2011. We're losing money along the way. Money's being eaten up by these other expenses somewhere in the middle. Okay? So the big question is, where is it at? Well, let's take depreciation. I'm going to calculate that. 400 divided by the sales. I'm going to copy that cell over. Okay, so you can see depreciation is going up quite a bit from 10.5 cents of every dollar to 16 cents. You see that I'm not really looking a whole lot at our subtotals. I'm not doing anything with EBIT. That's a subtotal, which is sales minus cost of goods sold minus depreciation. Not really doing anything with taxable income. Let's look at interest expense. $300 divided by the 2.5. So it was 12 cents in 2011, but it was a lot lower. It was even less than half over in 2009. So that's why this is dropping so much, for those two main reasons. You got depreciation and your interest expense that are ramping up. There is a page, I think 6, where I have all the numbers written out for you here. So this would be the full vertical analysis for Alcatraz income statements. And so you could compare 2011, 2010, 2009 and see whether the company is getting stronger or weaker. This is a required disclosure. So if you are looking for a public company and deciding whether to invest or not, you don't actually have to do all this out in public companies' documents. This is Hastings. So this is my old company back 5 years ago or so. And in their management discussion and analysis, in their 10K, they've basically provided this for you. So the last 3 years, 2008, 9, and 10, as a percentage of their total revenues here, so that's 100%. And these are their different percentages here. You can see that their profit margin wasn't very big in 2008, so they were making less than 1 cent out of every dollar in profit. 1 cent out of every sales dollar in profit is even less in 2010. But what are the big shifts that are going on? Let's look at this. SG&A is a big one, selling general and administrative expenses. So like store employee personnel, headquarters personnel, those type of things. You can see that it was only 34 cents out of every dollar, but now it's over 35 in 2010. So that's a pretty big jump. They're losing, that $1.50 of every 100 sales dollars in profit because this is increasing year after year. Okay, so you could do this, or you could actually go look this up for a public company, and now you kind of understand how they're calculating those numbers. Okay, any questions on vertical analysis, what we're trying to do? What you could do here as well, in addition to seeing our Alcatraz company right here, year over year, you can compare Alcatraz to another company. So for our cost of goods sold, if you were going to compare Walmart and Target, you could see what their percentage for cost of goods sold for their products is, and can see which one's doing a better business or a poorer business there. Okay, any questions here? Yes, Tyler.
How accurate is this at predicting or showing how a company's doing in regards to if they're going to go under?
Well, that's a good question. So this is historical information. So we looked back over on Hastings over here. And so this is fiscal year 2010, which ended January 31st, 2011. So, that's a while before. And so you can see the trends, though. So unless something significantly changed, they're not really picking up going forward. So it's not necessarily a crystal ball, but, it's a good indicator of possibilities there. Chris?
Yeah, kind of just to continue on that, are most companies this consistent, or the numbers kind of jumpy across the board? Because on these numbers are either consistently going down or consistently.
Are you talking particular Hastings right here?
Companies in general for years.
Would you consider this consistent or inconsistent?
Well, some of them are kind of either consistently going up or consistently going down. Is there some where it'd be kind of opposite? Like 1 year was 10%, the other was 15%, and the other was 9%. What's more common?
Well, typically they shift, unless management changes strategy or something, they shift in the same direction year after year. Now, and there's typically not going to be a major shift. So Hastings, for example, you would expect their SG&A percentage to be somewhere between 33 and 36% year after year after year. If they jumped up for whatever reason in 2011 to 40%, that would just be a huge change. So you typically don't see some major shifts like this, but if a company dramatically changes, so let's say there's a merger or Apple comes out with a new product that just totally revolutionizes everything, then you might see something significant go up. So let's say Apple figured out a way to make iPhones, instead of sending over to China and all these suppliers combining all the parts, where the cost of an iPhone is $200. Maybe they figured out how to make it for $20. Well, what would change here? Well, their sales are still going to be high, but their cost of revenue is going to be significantly lower. If something dramatically shifted in the business, then you can see a major change. But for the most part, not a whole lot. Okay, so you understand what we were doing. Horizontal was across year over year. Vertical is within the same year like that. Okay, so let's talk about ratio analysis. What we're doing with ratio analysis, there are basic ratios that are set up in finance to help you figure out some key indicators of a business. Okay, now this isn't totally objective. So I got up here apples to apples, and it's just as much an art as it is a science. So you can get a good indicator with ratios, but it's not always going to be necessarily red or green indicator. What you're trying to do here is you're figuring out a ratio. You're comparing it to their previous performance or to benchmarks in the industry. So we're going to go through several different ratios. We got about 15 that we're going to discuss. And you're going to say current ratio, for example. We'll come back to that here in just a minute. Do they have a good current ratio, and what does that say about their liquidity compared to the industry? Okay. So whenever you do a ratio year over year, the reason I say you got apples to apples up here, you want to make sure that you're comparing the same thing. If you're calculating current ratio in one method in the first year and then in a different method in the second year, you really can't make a comparison. Or if you're comparing two different companies and their calculation of some percentage is different, the way they go about calculating that number, well, that's not really an apples to apples comparison. So a lot of times in business, you say, well, is this really an apples to apples comparison? That's what that means. Are we comparing similar things? So what we're going to do is we're going to go through 5 different types of ratios here in just a minute. We got liquidity ratios. Liquidity, just as a refresher, what does that mean? Haley, what does liquidity mean? Liquidity. How well we can pay what? Our debts. All right, thank you. How well we can pay our liabilities off. Asset management ratios. How well are we using the assets that are entrusted to us? How well are we turning our inventory over? How well are we collecting our accounts receivable? We're going to look at some of those. Debt management ratios. So how well are we controlling our debt? Profitability ratios. Remember, one of our other business goals is profitability in addition to liquidity. So how profitable are we? So we're going to look at a couple different ways to assess that. And then market value ratios. How is our business in accordance with how it's valued out in the market? Okay, let's come back together. We're just going to go 1 through 15, and you guys are spread out all over the place, so I'm not sure where you are. But current ratio, I think it was Kent and Chris, is that right? You guys had current ratio. Tell us how you calculated. I got the little ratio tab right next to the balance sheet and income statement, so we'll flip back and forth. How'd you go about calculating current ratio?
So to get your current ratio, so we'll do current assets divided by current liabilities. So
Which up here we got 708
yeah.
divided by the 540, right?
Yeah.
Okay, and that gave you?
1.31.
Okay, that's not a percent. That should be a number there. Okay, 1.31. What does that tell you if you were expressing that in a sentence?
That tells us that we have more current assets than current liabilities at the
Okay.
moment.
Because it's greater than 1.
Mhm.
Okay.
And we read that for a healthy business, you want anywhere between 1.5 and 3.
1.5 to 3 for your current ratio. That seems a pretty reasonable current ratio. So if it was 3, if your current ratio was 3, basically you would have $3 of current assets for every $1 of current liabilities, and you had pretty flexible room to pay off your liabilities. We talked about last time, we talked about liquidity versus return. And we said current ratio of 3 to 1 versus current ratio of 10 to 1. Which one was better? 3 to 1 was better. So it's a little counterintuitive. Well, 10 to 1 basically means you're not using some of your assets properly. You can reinvest some of those current assets. If we flipped back over to our balance sheet, what are our current assets? We had cash, accounts receivable. We're not really getting any return on these guys right here. Well, if our ratio got way above 3, we would probably want to take some of these assets, move them down to our non-current assets and get a higher return. That's the idea there. Any other thoughts on current ratio? You understand that one? Make sure you're getting your current assets and your current liabilities, not your total assets, your total liabilities there. Okay? And this gives us an assessment of our liquidity. How well can we pay our debts? If it was below 1, then we're kind of in trouble. We got too many liabilities there. It went up 11%. So if you could compare year over year, which would be good if you're doing your analysis on your case. So let's just real quickly, we'll take our 2010 divided by that number, and we got 1.18. So you can see that our current ratio improved just a little bit. Pretty similar, but it went up a little bit. Any questions on that guy? Okay, quick ratio. Who's got that one?
So what we calculated, what we did is we first got current assets, and then
Okay.
we subtracted from the current assets our inventory.
So you got the 3588,
Yep.
okay? And you subtracted inventory?
No, we didn't have 3588.
Oh, sorry, current assets. Current assets, you're right.
Yeah, current assets, and then subtracting inventory from that, which is 422.
So 708
Yeah, minus 422.
minus the 422
Yeah.
Okay.
And, we divided that by the current liabilities.
divided by current liabilities. And you got
I got 0.53.
0.53, okay? We'll move the,
We did the same thing for the year 2010.
okay?
We got 0.46.
So if for 2010, you would take the 642 minus the 393
Yeah, divided by the 543.
divided by the 543.
Yeah.
Oh, got a formula error there somewhere. Let's try it again real quick. Put that in brackets. Okay, so 642 minus 393 divided by, hang on, I know what you're doing. Okay, we'll just put the numbers in here because the link going back and forth between the tabs. So tell me again the numbers.
Okay, so 642
Okay.
minus 393
393
divided by 543.
divided by 543.
Yeah,
And you got
0.46.
0.46. Okay, so are we improving or are we getting worse here?
We're getting better.
We're getting better. Okay, so we would hope that that would be quick ratio. What kind of goal are we shooting for here?
That's something we're trying to figure out here.
Okay. So would we expect it to be above or below current ratio?
Below, yeah,
It's going to be below because inventory is a positive number here. So this is always going to be lower than that, assuming you have any inventory.
Yeah.
Okay, but we don't necessarily need a number that's above 1. So, anywhere between 0.5 and 1 is probably good because inventory a lot of times is a big component of a lot of businesses, operations there. Okay, so this gives you a little bit quick. It's quick because what assets could we sell quick in order to pay our debts, right? Inventory sometimes takes a little bit longer, and so sometimes this ratio is used as well. Okay, we good there? Nick, next. Are you long-term debt ratio or total debt ratio? Okay. What do we got here?
You take your total liabilities.
Okay.
So the 3,588, when you want to subtract that lose equity. So we took the total current liabilities of 540 and added long-term debt. Ended up getting
What was long-term debt?
457.
457.
And divide that by your total assets, which is 3,500.
3588. Okay. Is that what you got? So 28. So you could say 0.28 or 28%. How would you express that in a sentence? What does that tell you?
For every, I was thinking interesting number, so like every $100 you have in your assets, $28 of that comes from loans.
Yeah, very well said. Okay. So how are we using our debt to finance our business? For every $100 of assets, $28 came from liabilities. Okay. So what would that tell you about equity? 72% would be from equity, right? So you can also make an inference in terms of your equity from this number right here. Did you compare to 2010? What number did you get there? 32? Okay, so remember, we saw this before, that they had paid down debt from 2010 to 2011. And so that you would expect their total debt ratio to go down year over year. Okay? So that's good. We're basically making an inference here in terms of our capital structure. How much of our financing comes from debt? We can do a similar thing here with debt to equity ratio. Who's got that one? Carl. Okay.
So you take total liabilities, which is your current liabilities.
Okay.
and long-term debt.
While we go through this, I'm going to flip over to our answer pages. So the last 3 pages of your packet here, and you guys can kind of walk me through this as we discuss here. So just for simplicity of having this all in front of us here, we're on the third from the last page here on debt to equity ratio. What do you got, Carl?
So you take your total current liabilities, which is 540, and
Okay.
add that to your long-term debt, which is 457, and get
Okay.
your total liabilities.
Okay.
Divide that by your total equity, which is 2,591, and you get 38.5%, which says that you are financed more by equity than
You got, what was your number?
38.5%.
Okay, 38.5%. And it tells you, tell me again what it told you?
Yeah, you're financed more through equity than
So you're financed more through equity. So if this was 100%, what would you say?
you're financed equally.
You're financed equally. So anything below 100 would be more equity. Anything above 100 would be more liabilities there. Okay? So you can say a similar thing. You remember above we said that up here 27.8% was financed through debt and the opposite was 72.2. So what if we did equals 27.8 divided by the reciprocal of that, which was the 72.2. There's the 38.5, which is that number right there. Okay, so it's a similar ratio to get you to the same conclusion there that we're financed more through debt than we were. I'm sorry, we're financed more through equity than we were through debt. Are you with me on that? Okay. Times interest earned. Who's got that? Chad.
We just look at our income statement and obviously put in the numbers, earnings, EBIT plus divided by the overall interest expense.
Okay, so you're using EBITDA, earnings before interest, taxes, depreciation, and amortization. We talked about last time. Why would you use this instead of net income? This excludes these four things, is looking at earnings before that. Do you recall the reason why we said that? If we're just looking at our operations, we're seeing what management really has control of. We don't have a lot of control of taxes, depreciation, and amortization. So all those are deducted to get to net income, so we might go a little bit higher and look at EBITDA in terms of what our operations bring in, okay? And so keep going with your explanation.
Gave us 3.3%.
Okay, so you took EBIT and then you added depreciation back. And so that's your numerator divided by your interest expense, and you got 3.3 telling you what?
Basically, that's a good number, but we use more equity and less debt to finance our assets. And something else that we saw.
Not necessarily. Not necessarily.
It means we can pay off our interest expense 2.3 times over.
Okay, that's more close to what it's saying. It's that how easily can we pay off our interest? Or is our interest such a burden that we're not ever going to be able to pay it back? So basically this tells us that whatever our interest expense was, we earned 3.3 times more in order to pay it back. And so you would hope this would be a fairly high number, right? If it was below 1, then you're kind of in trouble because your interest expense is greater than what you're earning to actually pay it off. You're never going to get out from under that debt burden.
Decreased like 30% the past like 2 or 3 years.
Okay, yeah, because interest expense was going up, right, year after year? Right. Okay, so if you wanted to compare year over year, then that number was significantly higher in 2010, 2011. Okay, good comment there. All right, inventory stuff. Who's got inventory turnover? Taylor. Okay. Okay, so here's our ratio up there, cost of goods sold divided by average inventory. Okay, cost of goods sold is a number on the income statement. Inventory is a number on the balance sheet. Why are we using average inventory? Anybody got an idea there? Why not just take cost of goods sold divided by inventory? Going once, going twice. Ideas there. What if we did this? Okay, so here is our income statement for the year, January 1st through 12/31. Cost of goods sold is on the income statement. We're capturing cost of goods sold across time, right? So we're seeing what is the cost of our product all the way through here. And if we only used inventory rather than just average inventory, well, we're going to be picking the final number right here on 12/31. What if our inventory level was like this? What if we were going along and then we had a big sale right at Christmas and our inventory dropped to here? If we use that number for our inventory and our calculation, well, we got a big skewing of our results here, okay? So anytime you compare something on the income statement in a ratio to something on the balance sheet, since the balance sheet is a snapshot, you want the average of the balance sheet number right there, okay? So in practice, what you're going to be doing is you're going to be calculating an inventory number on a daily basis. Companies are going to be seeing what their inventory is daily, adding it all up and dividing by 365. For our purposes, we will just take the beginning and ending, add them together, and divide by 2 to get our average, which is what Taylor did over there. Okay, so you got on the income statement, you got 1,500 there. That was your numerator, and then you averaged the two inventories right there, and you came up with, what was our number? 3.68, right? Yes. Good or bad? Ganna?
What?
3.68, is that good or bad? It's amazing inventory turnover. What does that tell you if you're putting that in a sentence?
It means that throughout the year, the inventory gets turned over.
3.68 times. So almost 4. Let's just round up to 4 and say that through a year we sell our inventory out 4 different times. You go to the supermarket and you want to buy some milk. That milk gets turned over 4 times a year.
Depends on what you're selling.
Oh, so it's not amazing anymore. Okay, so he just said it was amazing. Well, it kind of depends.
We're selling like airplanes.
We're selling very nice luxury airplanes. Okay, so he's not so sure anymore. But if it was airplanes, okay, so let's say airplanes, homes, cars, something like this. This would be a pretty good turnover, right? You're selling it 4 times a year. you would want a significantly higher inventory for bread or milk or something like that at the grocery store. So it's going to depend on the type of inventory you have. Day sales and inventory, who had that? Go ahead, guys.
So we took 365 days and divided that by our inventory turnover.
Okay, so you had to build off of this up here, right?
Yeah.
So you kind of had to calculate that before. So you took the 365 divided by that.
Yeah, and we got 99 days for 2011,
Okay.
and then 124 days for 2010.
So it's slowing down, right?
Yeah.
Basically you're saying how long does it take you to sell your inventory? Okay, so if that's milk, you don't want milk sitting on your shelf 99 days. You might not be super, you wouldn't be too unhappy if it was airplanes or something like that. So it depends, just like inventory turnover. They kind of tell you the same thing. Let's go quickly through AR turnover. Who had that? Go ahead, guys.
We took the sales, the total sales from each year. No, just from.
Total sales for the year. Okay, so 2011 sales.
2011, then took the average inventory from 2010, 2011, or not average inventory, average accounts receivable.
Average accounts receivable, okay?
And we got 14.16. Sold for shipment, or they received their receivables 14.16.
Okay, so basically we sold something, it sat in our receivables for a while, and we collected it 14.16 times throughout the year. Okay, so it's kind of a measure of how efficiently we're collecting our receivables. Is that a good number or is that a bad number?
It also depends on what we found.
Maybe, but not quite as much as before, right? So receivables aren't going to go bad for milk more quicker than they are for airplanes or something like that. The product goes bad and could change. So the inventory turnover is going to be more variable, but right here, if you're above 10 or 12, if you're collecting within a month's period of time, that's probably a good ratio there. Who had average collection period? Okay.
We use the AR turnover.
So you're taking this, you had to calculate this first.
Yeah, we're taking the 14.16 and we would divide that into 365 days.
Okay.
25.77 comes out to 26 days.
Okay.
Which is the average amount of days it takes to turn accounts receivable into cash.
Okay, good. So basically on 1/1, you sell something on AR, and then on 1/26 you collect. So that wouldn't be too bad. You're collecting within a month's period of time. So probably anything below 60 days is probably not too bad. You wouldn't want it to be too long because you're without your money there and you're having to finance your operations from other sources there. Okay, moving forward, our next one, profit margin. Who's got that? Kyle?
For profit margin, it's just the net income divided by sales. It's the same as when we did the vertical analysis.
Okay. You saw this somewhere else. If we went over to our common size income statement, there's 7.8%. That is our profit margin right there. Okay? So net income divided by our sales right there. And if you were expressing that in a sentence, what would you say?
7.8% of what we sell, we actually, that's the money we receive. So for we're selling units of $1, we get 7.8 cents off of each.
Okay. How much do we keep on the bottom line? Out of every $100, how many dollars do we keep? Well said. So you would typically want that to be a pretty high number. And that's going to change based on the industry. So I showed you retail. Hastings had like a 1% profit margin or less. Restaurants are pretty low as well. Technology is typically pretty high. So that could be a ratio that's going to depend on the industry that you're in. ROA, return on assets. Brenda.
The ROA measures the company's earnings in relation to all of its assets and resources.
Okay.
They divide the net income for the year, which was 195 divided by the average.
Okay.
2011, that average is 342.5, and you get 5.6%. And so that, out of every dollar you make, the profit that you're making, out of every dollar, you get 5.6 cents out of it in terms of the profit you're making.
Of what you invested. Right. So this is kind of the parable of the good steward, right? So the more that you have in total assets, the more you should be expected to make in net income. You would expect net income for a big company to be higher than those of a small company. This basically averages it out so that you can compare a large and a small company here. So again, this is a number for a particular year. Your net income is for a particular year. We need to take an average of our balance sheet number of our assets. We don't want just the final number. So we got to compare apples to apples over time versus a number that's kind of over time as an average, and you get 5.6. So out of every $100 of assets that are invested, we're returning $5.6. Okay, good. ROE, who's got that one? Go ahead, Kelly.
So you take the net income and divide it by the average total equity
Okay.
for 3 years, and it means that for every
Okay.
The previous year they made 11, so
Okay.
it's negative.
So we saw on our income statement that was going down. Net income was down year over year over year, and so this is actually going down as well. So for every $100 of equity, so this is our owner investment, they made $8 of net income, right? So good. We're just expressing that as a percent there. So that would be another thing that you can compare year over year. Okay, so a couple things here as we wrap up. Earnings per share, we're looking at actual market value measures. And these are things that are used all the time in investing. You hear this on the news. This EPS is probably the first thing that is published on a company's press release announcing their earnings. So who had EPS? You guys. Who's up?
So the net income was 195, and we took that and divided by earnings or shares outstanding, which was 33 million.
Okay.
Got 5.9%.
Okay, so you said 195, but that 195 over on the income statement was expressed in what? Millions. Okay, so sometimes somebody is going to do this, 195, and they're just going to put it in as 195, and then on the balance sheet it said there were 33 million shares. And so they would do something like this, 195 divided by 33 million. And you're going to get something ridiculously small and said they made no money. Well, this is really 195 million, so apples to apples, right? You need 0, 0, 0, 0, 0, 0, or take all the zeros out and do it like that. Okay? And so on our answers again, you came up with 591, right? And if you express that in a sentence, what does that tell us?
For each share made $5.91.
Okay, so each share, what was their profit allocated to that particular share? $5.91. PE ratio, we're almost done here. Hang on for just a second. PE ratio, go ahead.
Yeah, PE ratio was basically just taking that 5.91.
Okay, so we had to calculate this first.
Yeah, which we wanted, and then you divide it by the amount each share is worth.
Okay.
Which came out to 14.9, which the rating that is actually the average. And it's the ratio between what you're paying for and what you're earning on the stock.
Okay, good. Okay, and so this is another thing. If you go out to Yahoo Finance, this is going to be published, and this is an active thing that you track in finance. So this is from the previous 12 months. This changes every day, right? So your price goes up and down. So your PE ratio actually changes every day, every couple hours as well. And so as we go through all these, we got to figure out whether they're good or bad, just like we were talking about our inventory turnover. So 15 right there, that's probably about average. And so I got a couple notes here you can read through. 15 to 20 is just about average. What do you think Apple is right now? What do you think Google is right now? Some of these tech stocks, their price is way up. Their earnings aren't quite up to that level, and so they have a very high PE ratio. So you're paying a lot for what they're actually earning. Why would you do that? One of two reasons. Go ahead. Expectations. So you could expect that this earnings in the next year or in the coming years is going to catch up. Okay, so we have high expectations for the future, or maybe that price is just way too high. Maybe the market has overinflated it and it's not justified. So you kind of got two different options there, one positive and one negative. Market to book ratio.
So the market value was given at $88 per share.
Okay.
To calculate book value, we took the total equity divided by number of shares outstanding. So that was 2,591 million divided by 33 million.
Okay.
And so we got 1.12, which means that the market value exceeds book value by 12%.
Okay.
So that either means it's overpriced or it has significant.
Okay, so well said. And just real quick as we wrap up, this is your market price that we figured out before. So that price changes every day. You could just look up on the ticker and see what your price is. This comes from your balance sheet. So if you had trouble with that one, go back over to your balance sheet and you saw that here was our total equity right here. If you're figuring out the book value, you would just divide this by the number of shares. Okay, and so there's typically going to be a difference. Why is there a difference? Because this book value per share is a historical number. So we're basically saying as of that previous period end. So December 31st, 2011, what was our book value? This is our current market price. And so there's going to be some relationship there. More often than not, it's probably going to be a higher number than one. Okay, so the market price is in, expectations for the future. This is historical. So I want to look at this and say that that price is too high or anything like that. But that could give you an indication of whether the market price is too much or too small. Okay? Okay, we wrapped up. We got all the way through them. You'll get the chance to do this on the case. If you have questions, shoot me an email and we'll go from there.
Biola University offers a variety of biblically centered degree programs, ranging from business to ministry to the arts and sciences. Visit biola.edu to find out how Biola could make a difference in your life.